Most people think the Federal Reserve is something that happens to other people. Bankers, Wall Street, economists in suits. Not them. But right now, today, the Fed is directly controlling how much you pay for your mortgage, how much interest your credit card charges you every month, how much your car loan costs, how much your savings account earns. Every single one of those numbers is about to move. Here is what just changed. 6 months ago, markets were pricing in Fed rate cuts for 2026. Lower rates, cheaper mortgages, relief on credit card debt. That was the expectation. As of June 9th, the CME FedWatch tool, the most widely followed predictor of Fed decisions in the world, is now showing 70% odds of a rate hike by December. Not a cut, a hike. The story completely flipped. And if you are carrying a mortgage, a car loan, a credit card balance, or money in a savings account, what happens next directly affects your wallet. Today, we are going to explain exactly what a rate hike does to every type of debt and savings you have, and the 5 moves that protect you whether the hike happens or not. The veer is the situation most Americans are in right now. Inflation is running at 3.8%, the highest since May 2023. Mortgage rates are sitting at 6.35%. The average credit card rate for new customers is above 20%. The average new car payment just hit an all-time high of $773 a month in Q1 2026. People are already being squeezed from every direction. And now, the institution responsible for setting borrowing costs across the entire economy is potentially about to make borrowing more expensive. Here is the problem the Fed is facing, and why this matters so much right now. New Fed Chair Kevin Warsh, who just took over after Jerome Powell's term ended in May, inherited an economy running at 2 completely different speeds. Businesses and affluent households are stimulating growth, fueled by AI spending and record asset prices, while the average person is increasingly anxious and financially exhausted. Inflation will not come down below 3% without the Fed doing something about it. But raising rates risks tipping a fragile economy into recession. And cutting rates risks pushing inflation even higher. There is no good option on the table. And while the Fed figures it out, your mortgage, your credit card, and your savings account are caught in the middle. The federal funds rate is the rate banks charge each other to borrow money overnight. It sounds abstract, but it is the foundation that every other interest rate in the economy is built on top of. When the Fed raises it, every other rate moves with it. Credit cards first, because this is where a rate hike hits the fastest and the hardest. Credit card rates are variable. They move in lockstep with the Fed, usually within 1 to 2 billing cycles. The average credit card rate right now is already above 20%. Just before the Fed cut rates in September 2025, the average rate for credit cards being offered to new customers was 20.12%. A 0.25% hike pushes that to 20.37%. On a $10,000 balance, that is $25 extra in interest every single year. Small number, but it compounds, and across 45 million Americans carrying credit card balances, it adds up to billions extracted from household budgets within months of the hike. Mortgages next, and this one is more complicated. Mortgage rates are tied more closely to the 10-year Treasury yield than directly to the Fed funds rate. A rate hike signals the Fed believes inflation is still a problem. That signal pushes Treasury yields higher, and when Treasury yields move higher, mortgage rates follow. Mortgage Bankers Association and Fannie Mae still predict mortgage rates to remain near 6% through 2027. A rate hike changes that projection upward. Remember that expectation from 6 months ago? Rate cuts, cheaper mortgages, relief incoming? That expectation was already baked into home prices. Sellers priced their homes assuming buyers would have access to lower mortgage rates. A rate hike removes that assumption, and buyers pay the price, literally, in higher monthly payments on already elevated home prices. Savings accounts, and this one cuts both ways. High-yield savings accounts have been more effective interest payers, rates mostly in the 3% range, with an occasional 4% yield available. A rate hike could push those rates higher, toward 4.5% or even 5% on the best accounts. The national average savings rate at big banks? Still 0.38%. And car loans, the most ignored interest rate impact of any Fed decision. A 0.25% hike pushes that rate towards 7.25%. On a $40,000 loan, that is an extra $14 a month. Over 60 months, $840 extra dollars paid to the bank. For anyone planning to finance a car in the next 6 months, buying before a rate hike locks in today's rate. Waiting after a hike costs you. Here is the impossible situation the new Fed Chair Kevin Warsh walked into. Cut rates, and inflation potentially accelerates above 4%. Energy prices from the Iran conflict are already pushing costs higher across food, transport, and manufacturing. A rate cut adds fuel to that fire. Raise rates, and the housing market, already described by Treasury Secretary Scott Bessent as being in a recession, gets worse. Job growth, already slowing, slows further. The risk of tipping into a full economic recession rises. Hold rates, and inflation stays above the 2% target indefinitely. The Fed loses credibility, and markets start pricing in hikes anyway, which is exactly what the CME FedWatch tool is already showing. GDP grew just 1.6% in the first quarter of 2026. The economy is literally moving at 2 speeds, with businesses and affluent households stimulating growth, while the average person is increasingly anxious and financially exhausted. The Fed has to choose between protecting the wealthy half of the economy or protecting the average person. It has never been great at choosing the average person, which is exactly why you cannot afford to wait and see what it decides. All of them work whether the hike happens or not. All of them make you better off, regardless of what Kevin Warsh decides in December. Move 1. Move your savings to the highest yield account available, right now. High-yield savings accounts are paying mostly in the 3% range, with occasional 4% yields available. If a hike comes, those rates climb higher automatically. If no hike comes, you are still earning multiples of what the big banks pay. Either way, you win by moving. Move 2. Lock in a CD rate today if you have cash you will not need for 12 months. If a rate hike happens, new CD rates will be higher. But if you are wrong and a cut happens instead, you will have locked in today's rate before it disappeared. CDs are one of the few financial products where timing works in your favor on both sides of the Fed's decision. Move 3. Pay down variable rate debt aggressively, starting now. Credit card debt above 20% interest, HELOCs, variable rate personal loans. Every dollar of variable rate debt you carry is a dollar that gets more expensive the moment the Fed hikes. Eliminating it before a hike is the highest guaranteed return available to you right now. Move 4. If you are planning to buy a car in the next 6 months, buy before December. Adds $840 to what you pay over the life of the loan. Move 5. And this is the one that protects your long-term wealth regardless of everything else. Do not change your investment strategy based on the Fed. Rate hike anxiety drives some of the most expensive mistakes investors make. Selling index funds because of a rate hike. Moving to cash because the economy feels uncertain. Waiting for the right moment to invest. The data is unambiguous. Since 1950, the S&P 500 has averaged positive returns in the 12 months following a Fed rate hike, in 7 out of 10 hiking cycles. A rate hike is not the stock market's enemy. Uncertainty is the enemy. And the investors who stay the course through uncertainty consistently outperform the ones who react to every headline. The Fed made its decision in the dark for decades. Now you know exactly what a rate hike does to every dollar you have. And you have 5 moves that make sure, whatever they decide, your money is in the right place before it happens. Here is what we now know. The Fed funds rate sits at 3.5% to 3.75%. 70% odds of a hike by December, confirmed by CME FedWatch on June 9th. New Fed Chair Kevin Warsh inherited an impossible choice between inflation and recession. And every type of borrowing and saving you do is directly in the crossfire. A hike raises credit card rates within 2 billing cycles, pushes mortgage rates higher through treasury yields, increases car loan costs immediately, but also pushes high-yield savings rates higher if your money is in the right place. 5 moves protect you. Move savings to high yield now. Lock in a CD rate. Pay down variable rate debt. Buy the car before December if you need one. And do not touch your investment portfolio. The Fed will make its decision in December. You can make yours right now. If this video gave you a clearer picture of what is actually happening to your money, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money decisions before most people even know the questions to ask.